Welcome back, financial investors. My name is Brent, and today I want to go over 18 dividend aristocrats that have been growing and paying out dividends for the past 25 years or more. Now, of these 18 dividend stocks, these have been trading or are currently trading below their 200-day and 50-day moving average, and also offer a higher starting yield on the year than average. Now, I want to go over these fairly quickly, going over a top level. That way they can go out in front of you, the viewers and subscribers, and you guys, if you would like to maybe look into these specific stocks within sectors, maybe you're looking for a stock to add into a specific sector, you could do a deeper dive into these now that you know of the valuation, and maybe you would add any of these into your portfolio. Now, I'm not recommending any of these because I am not any sort of financial advisor. I'm just a guy, regular investor here on YouTube, sharing these stocks, and let's go ahead and get into the video. So if you are brand new to the channel, have not yet subscribed, hit that subscribe button below. If you do enjoy this video, find it helpful, hit the thumbs up. And if you have any comments or questions, drop them into the comment section below. I do read and reply to all your comments. And of course, let's get into the video. Now, I'm going to go ahead and share my screen here. This is an article I wrote over on back in the 5th of May, 2019. Now, it goes over 88 dividend stocks with 25 years of dividend growth. I broke this up by sectors, so I will have a link to this article here down in the comment section. It'll be the first pinned comment there. Now, this breaks up all these dividend aristocrats by sector. So if you're looking for a specific dividend aristocrat, come over here, check out the article. Now, if you scroll down towards the bottom, every quarter I have been going through this list and thinning it down, looking for stocks that are growing and paying out dividends. Obviously, they're dividend aristocrats, but also having rising revenue, net income, free cash flow, and possibly trading with a higher starting yield on average for the year than they have been in the past. Now, here back on the 15th of August, I pulled 39 stocks that were trading below their 200-day and 50-day moving average, and they offered a higher starting yield on average than it has had for the past year. Now, I had a bunch of stocks here. I'm not going to name them all off. If you guys would like to look here on the website, go ahead. But of these 39 stocks, I went ahead and did a little bit further. I went and I looked through these 39 stocks for which companies here within the list over the past 10 and 5 years have had rising revenue and net income and pretty decent free cash flow. Now, if we look at New Corp, here we go. Over the past 10 years, revenue up 105% or about 10.5% on average. Net income here in the orange up 1.36,000%, and their free cash flow in the red up 72% over the past 10 years. If we look at it also in the 5 years, all moving positive here in the up direction, positive direction. Next, we have HB Fuller, ticker symbol FUL. Now, both of these here are on the list here over in the basic materials. So here we have New Corp and Fuller, number 3 and number 4. So if you guys want to kind of make a note here within your mind and check out the article, these are the stocks there. Now, again, looking at the 5-year, everything is positive. Revenue at 42%, free cash flow, net income up about 184, 189% over the past 5 years. If we look at the past 10 years, again, moving in the upwards direction. So while these have been hit recently, these are basic material companies which have been hammered here probably due to tariffs or maybe some other volatility here in the market. But these could offer a recovery play here in the future, and that's why I'm kind of getting them out there. We will go over their price, their starting yields, and their 250-day moving average here. But I want to go over their net income, free cash flow, and revenue with you guys. That way I can show you why these were specifically set aside from those 39. Now, that ends the basic materials. Now we're moving into consumer goods. So the very first one here within the consumer goods was Hormel Foods. Here over the past 10 years, nice steady growth within revenue, net income, and free cash flow over the past 5 years. Nice steady growth here. Revenue. Now this is a very large company here, known for their canned goods and meats and spam, I believe. So revenue just kind of creeping steady over the past 5 years. Eaton Vance, full disclosure, I am a shareholder of Eaton Vance. And again, revenue, net income, free cash flow over the past 5 years, over the past 10 years, everything moving nice and upwards. T-Row, ticker symbol TROW. This one popped up a few times back in my January and maybe my May videos of stocks to watch. Now this one here over the past 10 years, very strong Now, T Rowe is our first one here in the financial. So those only Hormo foods within the consumer goods. So now we jump down into financials. So T Rowe, very strong revenue, net income, free cash flow over the past 10 years. If we look at their 5-year, here we see revenue of 3.9. No, we're dividing it by 5. So 40 by 5, that's 8. So 8% on average there for the revenue increase. 24 by 5 is almost, 4 point some. So decent free cash flow, mainly in banks. You're not worried too much about that free cash flow. I believe this is actually an asset management company, but free cash flow up 64% there, so nice and steady. Cole & Frost still within the financial, 5 years, everything upwards. 10 years, everything upwards. That's what I want to kind of showcase first. So Financial First Corp, very strong 10-year numbers. Actually, not so strong 10-year numbers, but still not doing bad. This is a very large dividend aristocrat. Again, these are financials that have grown and paid dividends through the past recessions. Let's go ahead and just show really quickly these financials here through the recessions. Let's go ahead and bring in these recessions. Oh, there we go, max. So through these recessions, let's go ahead and bring in the dividend payout. So this blue line here is their dividend being increased way back from prior to 2000. Through these recessions, this company, Eaton Vance, has continued to grow and pay out dividends for the past 25 years. T Rowe, look at those massive, steady increases there in their dividend. Some nice dividend payouts, so maybe they had some special payouts there during that time frame. Also, here we have Cole & Frost Bank. You can see the nice, steady upwards movements prior to the recession. You can see that dividend gapped up quite nicely and continue raising their dividend through the recession. And here, just recently in these last few years, you can see massive increases in their dividend income. First Financial Corp, I believe we had not covered this one yet, but still, we can see the revenue, net income, free cash flow over the past 10 years. So we're looking at the max. If we look at it over the past 10 years here, nice steady increases for the past 10, steady increases for the past 5. I think that dividend is kind of dragging these percentages. I'm going to go ahead and remove it. But all of these, again, have grown and paid out dividends during the financial crisis and during the 2000 tech crash. Again, these are dividend aristocrats having paid out for the past 25 years or more. So this would go back into, I think, the 90s. So we have Compton Financial Corp, ticker symbol TMP, 5 years and 10 years. I think this may get a bit, I'm sorry if I'm going over these too quickly. If there's anything you see that you want to have a little bit further time looking at, just pause the video. Otherwise, this video will become very long, and the primary reason for creating this video is to kind of get these stocks out there, out in your eyes again. That way, if there are any financials that you're looking into, these could be considered possibly doing a deeper dive. Next, we're diving into healthcare. So AbbVie has been having a ton of videos produced about it. I know PPC Ian created a video on AbbVie. I know many other channels did a bit of a deeper dive into AbbVie. I am full disclosure, I do own AbbVie myself. Here, over the past 10 years, rising revenue, free cash flow. Now, recently, their net income has been dropping, and this could be due to their patent having expired over in the US or possibly overseas. I don't have my notes here on hand normally, but I know one of their patents has expired either here in the US or overseas. Well, I'm going to go ahead and showcase their 5 years. So still, over the past 5 years, they are still chugging along. They just recently made a new acquisition, which should help their net income here. Johnson & Johnson, now this is due to tax reform right here. So this little negative 5.71. Johnson & Johnson still a strong, growing company, but tax reform seemed to have done something here with their books, which shows them as a negative for the past 5 years. That is just here due to that blip here in 2000 tax reform. Now 10-year, we can see here massive dip there, which was incorrect, and then they kind of corrected out. And here we can see Johnson & Johnson over the past 10 years still positive. Ticker symbol MSA. Now MSA is, okay, another healthcare company. I'm not familiar with this one. That is why I am going through these companies. Now I may not be familiar with it, but when the financials look straight and the current valuation looks good, then I will do a deeper dive. There's no reason for me to look deeper into a specific company if it is not trading at a valuation that would make it seem approachable or worthwhile adding it to the portfolio. So MSA, 10 years, revenue, net income, free cash flow, all positive over the past 5 years. Everything continuing to move here in the upwards. Stanley Black & Decker. Now this one has had a bit of some issues here in their net income here recently. I don't know if this is due to tax reform. This is showing a negative of 0.6%. Full disclosure, I do own Stanley Black & Decker. It's a good long-term buy and hold for my portfolio. It recently bought over the tools, some Sears tools, the product line. I believe it's Craftsman from Sears. So this one had a little bit of tough times here within the 5 years, but if we look over the 10 years here, nice steady upwards revenue, net income, and free cash flow. Now this dip here in 2018, this could be due to them adjusting their books with the new tax reform rules. So we'll kind of see how this kind of plays out here in the future. Walgreens, another full disclosure, I own ticker symbol WBA. Walgreens Alliance, they recently did an acquisition overseas with, I can't think of the company that they're acquiring. I know they made the acquisition announcement, I believe back in November, December, but Walgreens, nice upward since 2015, almost 5 years ago. So their 5-year growth for Walgreens is going to show much stronger than their 10-year. Over the past 10 years, between 2010 and 2015, you can see revenue, net income, and free cash flow basically trended sideways. It wasn't until recently in these past few years where the revenue, net income, and free cash flow has actually been spiking. So that is why I decided to add Walgreens not too long ago. Genuine Parts Company here, nice upwards over the past 10, over the past 5, looking pretty steady. Now Genuine Parts, they may be affected by the tariffs. Oh, we jumped out of Walgreens was our last. No, Stanley Black & Decker was considered a industrial goods. So we had actually moved out of healthcare after MSA. Stanley Black & Decker is our only industrial goods. Walgreens is considered services. They provide pharmacy and many other pharmacies around the world. So WBA is within the pharmacies. Genuine Parts is also within services. And GWW, which is WW Granular, is also within the services. So here, 5 years, revenue, net income, free cash flow. 10 years, revenue, net income, free cash flow, all positive. And then our very last one here for this revenue, net income, and free cash flow is 3M. Again, this is another company that has been on a lot of investors' buy and watch lists, having grown and paid out dividends for the past 25 years or more, and it has been taking a hit here recently, but their financials are still pretty intact. Over the past 5 years, yes, they've been having a bit of an issues, but this could be due to this little dip here. It could be looking like it's due to tax reform, and there's also been some issues out there with slowing due to tariffs, due to just overall slowness within the economy. But still, over the long term, if you're buying and holding this for the long term, it generally has these dips. If we look at its max, we can see here it goes through times in the recessions. You can see every time there's going to be a recession, what happens to the financials? It goes a little bit wonky. You can see here in the free cash flow dips down. You can see here net income dips down. Revenue stays about even. So revenue is one of those factors that looks like it trades pretty much in line, but you'll notice that their net income and free cash flow tends to wiggle around going into recession, going into a recession here, going into possibly another recession here in the short term. Now, that's just what I'm kind of gathering from the charts. Now, we've covered their revenue, net income, and free cash flow going positive over the past 10 and 5 years, which is why I wanted to kind of showcase with these companies with you guys. Now, we're going to go ahead and go over their price, dividend yield, 200-day and 50-day moving average. We will also take a look at their, let's see if I don't want to put too much in this chart. That may look a little bit, it may be a lot to look at, but we'll kind of go over it fairly quick. What are we at? 14 minutes now. So if you have any questions, drop them into the comments section. If there's anything you would like to do a deeper dive into, specific companies, or if you have any of these in your own portfolio, let me know. Now, Nucor Corp, again, back to basic materials. This is a gold company, gold-related company. Now, starting yield 3.23, which is very high here for the current point here within the last year. That means that price is trading at 52-week lows. You can see here, it is currently trading near its past support. So back earlier, maybe a month or two ago, it hit this $48 point, bounced up into that $55 point before coming back down. Again, this is gold related, so this could be an interesting gold play to research and look into. What caused it to fall back into this $48 range to retest its support level? Here at 56 and 53, it's 200-day and 50-day moving average. Here at 6.9 is its current price to earnings ratio, so not high in comparison to the S&P 500 average of 15. So it is trading below that S&P 500 average of 15 that you're looking for. If we're looking at price to book at 1.44, so basically a 1-for-1 price to book value of the company, and you can see price to sales is actually trading below 1, meaning that you're paying less right now for the price of the company than their sales are actually producing. So interesting kind of company there, valuation wise, trading near support levels and has had this support, and it actually bounced off its past support. It's now kind of trending here in the $48 range, but this one, research it, see what drove it to this price. Is there anything in the future that could potentially boost it back into that $56 point or even higher? Next, we're jumping into financials. I have nope, Fuller. That's still a basic materials. Here, ticker symbol FUL, trading again below 50-day and 200-day moving average at $46 and $45. It's currently trading at $41.98, putting it several dollars below its 200-day and 50-day. It is offering a starting yield of 1.5, so a lot of investors are looking for that maybe 3 to 6% range starting yields. This one's not offering at that price. Here we can also see price to earnings fairly high for a basic materials, trading at 52-week lows, and this one's actually been downtrending here for quite a while. Let's look at the 5-year time frame really quickly. We can see some highs of in 2018. This hit some highs and has just recently broke down into the $41. So this company, Basic Materials, could be hit really hard right now due to tariffs and trade war. So you can see here, mid 2018, this took a huge hit, probably as President Trump enacted tariffs on steel and other materials. I'm not specifically sure what this company does. I know it's in basic materials, so it has to have something to do within that specific sector, but this could be getting hammered right now due to trade war. And once we get out of that trade war, say we make a deal, we pull those tariffs off, we can see this stock ricochet back into that $54 range. If you look at its 10-year here, it just normally trends upwards, but here we can see, we'll look at the max chart looking at through the recessions here. Yes, it dips through these recessions pretty heavy, but then it does a full recovery here back in that 2000 recession. This one's been through many recessions. Look at all those recessions that it's gone through, and this company has always recovered and moved higher while growing and paying out a dividend. So just something really interesting to kind of check that out here in the charts. Also, price to earnings is at 17.14, which seems pretty high. Say you bought this down at the $40 range, you still wouldn't be getting too high. Maybe a 15 PE. Doesn't look like it comes down very often. Price to book at 1.8, so below that 3.0 range, and price to sale is at 0.7. So kind of an interesting basic materials. Hormel Foods. Now we're jumping down into consumer goods. This is our only consumer goods here that we're going to be looking at. Now, Hormel Foods here recently jumped out of its 200-day and 50-day moving average. If we look at the 30-day, 3-month chart, 90 days, we can see here recently when I made this article, it was trading below its 50-day and 200-day moving average. Recently, just within the last day or two, Hormel Foods put on a nice percent gain, moving from that $41 point up until almost $43. You can see here, price to earnings is fairly high here at 23.49, but that looks about average for this specific company here. You may get Hormel Foods down into the 20s, but over the past 3 years, it's very rare to see this company drop into that $20 price to earnings ratio. Starting yield at 1.9. If you could have locked this in at, say, a 2% or higher, that seems like a pretty good valuation for Hormel Foods. Price to book 3.8 seems a little high book value, but this isn't a book. Book price to book is not really considered in this sort of company. It's a sales-driven company, so 2.4 is actually a fair valuation for a sales-driven company. You're looking for anything below a 3 here generally. So Hormel Foods, while it was trading below its 30-day, let's go ahead and cut the volume here. It was trading below its 200-day and 50-day moving average. It has recently broke out and could be trending to some new highs. Eaton Vance Corp over the past year, here we can see here it just recently broke above. Let's go ahead and look at the 3-month. So recently it was trading, I picked this up not too long ago, I believe. It was trading below its 50-day and 200-day moving average. Recently broke above its 200-day simple moving average, now at 40.74. It offers a 3.44% starting yield, not the highest as it has offered in the past. If you can get this, say, at a 3.6 or almost a 4% starting yield, that could be a fair valuation as well. And price to earnings ratio, PE ratio over here on the side, 12.2, which seems pretty in line. This being an asset management company, I would look at price to book value anywhere below a 3 here. So 2.8 seems right in line. Price to sales in red here at 4.2. This is not a sales driven company, so this would be more of a price to book sort of services and financials company. So 2.8 seems fair within Eaton Vance. Next one here is T-Row, ticker symbol TROW. This one is currently trading at 109, so this one recently probably broke out as well. So back when I made this article here, back on the 15th, it was trading below its 50-day moving average. It recently has broke above its 50-day moving average. You can see here down in the 101 point is where its 200-day moving average is. So it's had some hard points back in December, maybe even earlier. I don't own this one. I know it's been on my watch list for quite a while. It does offer a starting yield of 2.67, a price to PE ratio, price to earnings ratio of 13.73, 4.8 price to book, and 3.9 price to sales. I say this one, if you can get it anywhere probably below that $101 point, that seems like a fair price here. Back in just maybe June would have been that good opportunity. Colin and Frost, ticker symbol CFR, currently trading here at the 1 year at $84.62. Now this one is trading both below the 200-day and 50-day moving average, having a starting yield of 3.21%, price to earnings ratio of 11.91, putting it at the lows for these financials that we've been covering so far. Price to sales, not really important in a financial company. This acts more as a, say, JP Morgan or a Wells Fargo. Normally in a typical banking institution, you would look for a price to book value of 1.7 and below for these specific more bank style financials. So 1.4 actually pretty good valuation for this company. If we take a look at it through the recession, how has it moved in the past here? Price generally moves upwards during the recessions. You can see it dips generally during the recessions and then does a full recovery. Price generally moving in the upwards direction. Just recently, looks like it's been taking a hit here. Midpoint 2018 is when it started to kind of come off those high points. It stopped moving higher and started moving lower. Maybe look into why exactly caused this stock to trend low. You know, what has caused these stocks to trade low? So if you see any of these companies that look like they require more information, dig into them, find out what has caused them to, fall as much as they have and offer the current valuations where they currently are. So next, First Financial Corp, ticker symbol THFF, currently traded at $40.98, putting it slightly above its 50-day moving average and slightly below its 200 simple day moving average. Starting yield of 2.51, putting it fairly high here for the past 3 years. You wouldn't have got a 2.51% starting yield, so this is actually fairly high here for the past 3 years. Price to earnings, we're still looking at financials, so fairly low there at 11.3. Price to sales, not really important in a financial, but we're looking at that price to book. So price to book's at a fair 1-for-1 here. So we're looking at a 1.05. So you're paying book value for the price here for this specific company. Kind of interesting. Ticker symbol TMP, the Tompkins Financial Corp, trading below the 50-day, 200-day moving average. This yield could possibly go lower. This company, you can see its support back in the past is actually below that $72 point, maybe $71, $70. So this one has actually kind of trended mid. It actually looks like it fell hit some support here just recently and has kind of been doing an upwards movement off these lows. So offering a 2.56% starting yield, 14.92% price to earnings. Price to sales not important. Price to book 1.7. That's in line with other financials within the JP Morgan, banking institutions. First Source Corp, ticker symbol SRCE. Again, trading below that 200-day, 50-day, offers a 2.39% starting yield, price to earnings of 13.24. If we look at the price to book, 1.425. Again, if we look at it over the past recessions, we'll notice that this company, again, this one has actually trended pretty sideways for the most part since 2000 until, say, maybe 2000 and I'm not sure how far away that is, maybe 2016. So from 2000 to 2016, it really hasn't gone anywhere. You can see here this price was around $24. 2016, it was around $24. It broke to all-time highs just in the last few years and has been coming back. This could actually fall a fairly bit more. This one's a little bit more erratic, or maybe it's even been building up pressure for such a long time that's what's kind of what it broke out. So 1 year, trading below 50-day, 200-day, 2.39. We already sort of covered that information. We're going to move on to the next one. Now, the last financial, Commerce Bank Shorts, ticker symbol CBSH, currently trading below 50-day, 200-day moving average. Starting yield is high for the year. We're basically looking at an all-time high here, starting yield of 1.69. Price to earnings actually seems a bit high here at 15.27 for a financial. We also see price to book is fairly high at a 2.0. So this one, while it is trading below its 50-day and 200 moving average, its price to earnings and price to book does show that it could be possibly a little high and could still fall a little bit further down. So as we had already seen earlier, I thought, could just be kind of pulling back and retesting. Who knows? But it's out there. Okay, now that was the last financial. No more financials. Now we're over into the healthcare companies. Now, AbbVie has been taking a beating here, trading quite a bit now below that $70 point. So here, I know it's been actually kind of moving higher here in the recent few months. So here it hit a low of around $62 and has been trending upwards now. I know there's a big insider, I know it posted over on Facebook, big massive insider buying going on. So it is trading currently below its 50-day, 200-day moving average. Full disclosure, I do own AbbVie. I'm not sure if I've said that in the past. Now, AbbVie is offering a 6.18% starting yield. It does have a high price to book or price to earnings of 24.96. Actually high on the year, not the highest, but obviously one of the highest points in the year. It also has a price to book of 3.1. I don't see a price to sales here on the chart, which is kind of interesting. So we'll go ahead and continue. Johnson & Johnson for the 1 year, trading both below 200-day, 50-day moving average. Starting yield not highs for the year, but fairly near highs at 2.78. It does have a pretty consistent PE, actually a very low PE right now. If you look at this chart, if I were to remove everything, just focus on this purple line here, you'll actually see that this purple, it came down from a very high price to earnings. That is because of tax reform. So it's offering a price to earnings of 21.85. Price to book is 5.7, and it's a sales-driven company. Johnson & Johnson sells a ton of products. The main focus here is price to sales is at 4.3. So it generally sells pretty high. It's a premium price for a premium company here. So 4.3, I would say that's pretty high, but with Johnson & Johnson, that may be fairly good. And a lot of investors are actually diving into Johnson & Johnson. Anywhere below 130 is where I've seen a lot of chatter going on right now. I just recently been buying Johnson & Johnson here on Monday and did another buy on Wednesday. So I've already made videos on that. Ticker symbol MSA. This is our last healthcare. Trading below that 200-day and 50-day moving average, offers a starting yield of 1.57, high PE of 32.84. I would consider that very high, double the S&P. Price to book 5.7, and price to sales 2.9. So actually price to sales doesn't look so bad. Anything below a 3 here for the sales driven companies here within the healthcare actually seem decent here. We can see over the past, we'll look at the max, how this company has performed here during the recession. So during the recessions, it does pretty hard sell off, pretty hard, but then it recovers it all here within 3 to 4 years and then moves higher. Let's see here, kind of looking at the charts. This one actually looks a little bit, could be hurting during the recessions. It looks like it bleeds off quite a bit in the recessions. Next, we're jumping down into services. So our first services is, we're not services, industrial goods. So Stanley Black & Decker is our industrial goods. Looking at the 1 year, it recently broke above that 134. So 200-day simple moving average was at 134.72. Full disclosure, I do own Stanley Black & Decker. It is now traded at 138.68, putting it still below its 50-day moving average. It offers a starting yield of 1.9, not the highest for the year. If we look at it for the year, our actual high starting yields actually puts it above 2.15 in that range, but still fairly decent. High price earnings of 29.5. Price to book and price to sales both fairly there. Price to sales here in the green at 1.4 and price to book at 2.8. Next, we're looking at Walgreens, trading at $50.95, putting it below 200-day and 50-day moving average. Walgreens, if you look at the starting yield for this specific company, it is trading at all-time highs for its starting yield of nearly 3.5%. So if you look at the history of Walgreens over the past history of this company paying out dividends, let's go ahead and bring in dividends in here. This company, dividends is in this blue line. I'm sorry if it's really hard to see in the mobile devices or just in this graph, but this company generally trends higher with its dividends and its price. Now, Walgreens has been taking a hit recently. I believe that's because of Amazon, JP Morgan, Berkshire Hathaway announcing they're trying to get into the pharmacy industry. But overall, you've seen, what's the other company? CVS. Can't think of the specific name of the company. CVS Health Corp, so that's why I can't think of the name. And Walgreens has actually been driven down lower due to the announcement, but again, we looked at their financials. Their financials are in order, so this is actually offering a very high starting yield compared to anywhere it's been in history. Price to earnings 9.9. Price to book is 1.9, and price to sales. This is a pharmacy company. It's a sales-driven company. It's trading at a price to sales of 0.352. Interesting to kind of throw that out. Genuine Parts. Now we're moving down into the services. Ticker symbol GPC. This one here trading at $89.81, putting it below 200-day and 50-day moving average, having a starting yield of 3.3%. See for the 10-year. Over the past 10 years, not the highest. If you bought it during the recession, that would have been the highest point, but you could either buy it now at a 3.3 or wait for a recession. Now, looking at the price to earnings, it's at a 16.69. Price to book, 3.5, and price to sales, sales-driven company, this is at a 0.69. WW Grainar, ticker symbol GWW, again trading below that 50-day, 200-day moving average, having a starting yield high for the year of 2.05, price to earnings of 18.63, price to book high, but again, this is a services-driven company, which is mainly price to sales, so price to sales at a 1.3. Fairly there, 1 for 1. And our very last one, dropping down into conglomerates, is ticker symbol 3M. Now, 3M has taken a huge hit again just within the last 5 years. When did we start these tariff talks and, tariffs, trade war? Back in 2018, it's just been getting hammered here this whole time. Now, finding some support at 160 while it's been bleeding out these past years. We're finally finding some support here. Back in 2016, we were trading at this $160 price. It is now back at this $160 price with highs of actually over $240. So if we look at the history of 3M, generally, I think that's a lot of history. Let's go ahead and knock out. This is our very last company, so we'll knock out a few of these. We'll just look at the price and the dividend. But here's that dividend. It's been paying a dividend since maybe back in 1985. And we can see that price just nice and steady. Yes, during the recessions, it does come down hard during recessions. Look at that pullback. But it generally recovers with time and just trends to move higher. Now, this pullback pulled it back until 2016 price. We'll look at the 10-year. So here, the last time, 2016 midpoint there was where it's currently trading at right now. And we can see here nice steady dividend increases over the past 10 years. So I know that was a whole lot of information that we covered. If any of you guys actually made it to this point in the video, drop me a comment in the comment section letting me know, hey, I made it to your 35-minute point in the video. Look, I think this is a long video, but I wanted to get these stocks out in front of you guys. That way, if there's any companies within basic materials, healthcare, industrial goods, financials, services, or conglomerates that you are interested in maybe adding to your portfolio, all of these are dividend aristocrats. All of these have rising revenue, net income over the past 10 and 5 years. Yes, they're going through some volatility now due to trade wars, due to a slowing economy, but that is for you guys to do a little bit more research. What is actually driving these prices down? What has driven these companies down in the short term? Do they have a lot of debt? Now, I could go through here and sit through the debt, the long-term and cash equivalents, but that would be a lot of, I don't want to tack on any more minutes than we currently have. So a lot of these companies, these are dividend aristocrats, so it's going to be pretty hard not to see a lot of these companies with a lot of debt. I think the main thing may be to check out the operating income and the capital expenditures. How much money are they bringing in per quarter? How much are they spending? So capital expenditures, $421 million when they're bringing in $1.7 billion for 3M. That's fine. $380 million to $47 million going out. Again, that's not bad. So that's what you want to kind of do is look at these companies and look at how much debt they are, how much assets, their liabilities do they have, what's the return on invested capital. Nucor Corp, 15.19. H.B. Fuller, let's make sure I'm not in my percentages. H.B. Fuller, this was a basic materials, 3.72. Hormel Foods, 16.09. So your return on invested capital. So if you invest capital within this company, what do they make with your money? What is their return? Eaton Vance, 16.42. T. Rowe, 31.26. Cullen & Frost, 12.57. First Financial, 9.6. Tompkins Financial, 4.87. First Source Corp, 8.57. Commerce Bankshores, 14.48. AbbVie, 15.89. Johnson & Johnson, 17.77. MSA Safety, 11.58. Stanley Black & Decker, 5.08. Walgreens, 11.32. Genuine Parts, 11.47. WW Greener, 19.06. 3M, 19.38. Now, this is not a Tesla. If we look at Tesla, Tesla's going to have a negative. It's not making any money out there. If we look at Apple, I know Apple's a good comparison. It's also a dividend company, 25.15. So that kind of puts these companies in comparison to their return on invested capital. So that is all I wanted to cover in today's video. Again, all of these companies are going to be in the article over on my website. I will have a link down in the comment section below. Go to the article, check out these stocks. They all have, on the 15th of August, I took a snapshot of where they were trading. So for example, Hormel Foods was trading at $41.42. Now it's trading at $42.95. So 42. So it went up almost $1 and some 50 cents there, but I know it gapped up pretty nice in price. Let's go ahead and go to the full screen here. And there we are. So I know it was a very long video. I want to go ahead and thank you all for having been through that. If again, I know it was a lot of information. I covered 18 stocks, growing their revenue, net income, their free cash flow over the past 5 and 10 years. We've also covered the price, their current starting yield, where their 200-day, 50-day moving average, what is their price to earnings, their price to sales, their price to book. We also looked at their return on invested capital. I generally don't invest in too many companies that have a return on invested capital below 7%. I look for companies that have at least a 7% return on my invested capital, and most of those companies there that I just showed you all have a 7% or higher. Also, these are all dividend aristocrats, meaning that they've grown and paid out dividends for the past 25 years or more. Some of these are even dividend kings, so that is something to check these out for. Now, just because a company does pay a dividend now does not mean it will not pay, or it will pay dividend in the future. So when you're looking at their information, look at their payout ratio. How much of their earnings do they pay out to their shareholders? How much of their distribution to their shareholders is actually covered by free cash flow? If for whatever reason their earnings fell, would they be able to pay out their shareholders with their free cash flow if they had to, just to keep that dividend aristocrat status? And just kind of do more research on these companies. So that is it for today's video. Thank you all for tuning in. I want to give you a big thumbs up myself, letting you know that I appreciate you having sat through this video. And if you guys did enjoy this video, I know it was long and drawn out with lots of information, lots of graphs, hit the thumbs up button below. Let me know in the comment section that you stood here to the end, and subscribe to the channel if you're interested in dividend stocks, stock market, or real estate. And thank you all for tuning in. I will see you next time. Have a great day. Bye.